I'm Ron DeLegge with ETF Guide TV. Great to see all of you. I hope your summer's going well. I've got some charts that I want to share with you, so let's get right to it. Beginning with a poll that was on our community tab right here on ETF Guide TV asking you, well, how's your investment portfolio doing, right? Here we are halfway through 2024, and this was about evenly split, a third, and a third, with some of you saying I'm doing better than the S&P 500, others worse, and then others even, and then about 9% not sure. For those that are doing worse than the S&P 500, two things to keep in mind: the duration and the degree of the underperformance. Those are two things that we need to really think about, because if the duration of the underperformance is continuous with almost no end, then that's a problem, right? That tells us the orientation of the portfolio clearly is off. The other thing is the degree of the underperformance. If it's significant, well, then that also tells us that the portfolio could be misaligned and allocated to the wrong types of assets. Now, there's going to be naturally at times periods, hopefully temporary, of underperformance. But again, the degree and the duration should not be significant or long. And so those are some things to think about. And then we also had some comments just below that poll, specifically about how some of us have been doing. One that jumped out to me, Liberty, saying he's been doing worse, and he feels like having a high-risk portfolio that should perform in a bull market, but isn't. And he's learning kind of the hard way. And so that again speaks to the degree of the underperformance. If it's significant, then clearly the portfolio needs to be realigned and looked at. Now, speaking of high risk, ARK-K, which is one of the most concentrated actively managed ETFs out there, we've been seeing a lot of launch activity as far as new actively managed ETFs, and this was one of the first. And this is an ETF that got a lot of notoriety during the COVID crisis, and it performed quite strongly up and through that, but since then has really been a stinker. And so the smart lawyer, one of our viewers with that username, wanted to see this battle of ARK-K versus VGT, which is a information technology sector ETF from Vanguard. And so guess what, smart lawyer? We're going to do this battle this upcoming week, so stay tuned for that. Watch for it, and it's going to be epic. Now, taking a look at the actual performance of major asset classes, let's look at a couple. We got SPY, which tracks the S&P 500, ahead by a delicious 17.43%. Now, this is since the beginning of the year up through the market close of July 5th. So very strong returns for S&P 500. As far as some other asset classes, we see bonds, BND, lagging significantly, barely up. And then Bitcoin, IBIT is the spot Bitcoin ETF from iShares, ahead by 15.25%. And look at Bitcoin. You see it up here in the red, this red line. It's really come off its high of the year, which was achieved earlier. I think that was in second quarter, with a 50% gain, now up just a nudge over 15%. And we've seen a sell-off and pullback in Bitcoin. And then REITs have not been good performers. Of course, higher interest rates have been weighing on this particular sector. REET, global real estate. And then SDCI, which has benefited from higher inflation. Commodities continue to prove themselves as a strong inflation hedge and a great portfolio diversifier. SDCI, by the way, is one of the best core commodity funds out there. So if your portfolio has no exposure to commodities, or you're looking to add a little bit, check out SDCI. It's got a great diversified approach. In terms of industry sectors, S&P 500, there's 11 industry groups, and you've got 10 up, 1 down. This is overwhelmingly bullish when you've got multiple industry sectors performing to the upside. And look at that. We've got 4 sectors in double digits, and then 2 above 20%. So again, strong performance across the board from all industry groups. The only one, of course, lagging is real estate. Now, in terms of best performing ETFs for the second quarter, one that jumped out at me was the Direction HCM Tactical Enhanced U.S. Equity Strategy ETF. And this particular ETF is managed by our friends at Direction. And we're going to talk about this one in the third quarter, specifically understanding what the investment strategy is behind this fund. But congrats to Direction for being one of the best performing, or having one of the best performing ETFs from the second quarter. And then, of course, you'll see a list of some of the others. You'll notice that there's a lot of emphasis and focus for these top performing funds on growth stocks. And so that's where the action has been. That's where the hot performance has been in those growth type of names. And that certainly explains why there's so many growth-oriented ETFs on this list. In terms of the big money, I always like to take a look at this to ask and understand, how did the big money make their fortune? And if you take a look at the top 10 billionaires, this is the big money. You don't get bigger than this. Elon Musk tops the chart, $256 billion net worth. But you'll notice the green check marks here to the very right. And you'll notice 8 out of the top 10 billionaires, how did they make their fortune? It was in the technology sector. That's where they made their fortune. And so I think, again, as a public service announcement and reminder, in orientating your investment portfolio, I think that's beneficial and a great lesson for the rest of us, that's how the big money made their money. And so for us, I think orientating that portfolio, those investments, more towards technology. And there's a lot of things that encompass technology. It's not just software and, computers and mobile phones. There's a lot to it. You've got artificial intelligence, AI, you've got blockchain, you've got cloud computing, you've got machine learning. There's just so much to it. And so, again, there's lots of ways to play this. Obviously, ETFs that are thematic, that touch on some of these investment themes, are easy ways to get exposure to this. So keep that in mind. In terms of politics and government spending, and this was kind of interesting because, we don't really get into it very often, and this is a politically neutral channel, so we don't get into political arguments because it's a waste of time. But we're not mathematically neutral, by the way. And when it comes to government spending, a budget deficit is basically where the government spends more than it takes in. Very simple to understand. You don't need to be a genius. And under Biden and Trump, government budget deficits have been the highest ever in the history of this nation since FDR. That was way back during the World War II era. Naturally, if you're involved in a world war, you're going to spend a lot of money on defense and things related to that. But we're not in a world war. We're in a different kind of war. But the point here is that the government spending runaway spending continues to exceed the amount of money they're taking in. And that's a massive problem. That's a massive problem. And before I point out what this is leading to, I just want to also point out that both of the current presidential candidates for this year have both been big spenders, at least under their presidency. So it's not who has spent less. They've both been bad in this department, okay? So just FYI. And that's not, again, a political statement. This is math. This is math and this is history. So please familiarize yourself and educate yourself with what's happening as far as government spending. David M. Walker, former Comptroller General of U.S. Government, spoke about this, and he actually wrote a couple of books about this. You can check those out at Amazon.com. Highly recommended. And his whole point is, listen, you cannot continue to spend this kind of money with tax rates as low as they are in the U.S., and his whole point is that tax rates in this country are going to skyrocket. And he's not alone in that thinking. There are many others that agree with that, including myself. And this is one of the what I call financial icebergs that we really need to think about and plan for when it comes to our investments. It's not just inflation or market crashes. But there's also other things in our financial and retirement planning that we should be thinking about. Obviously, illness and accidents, those are things that we should be prepared for. But taxes, orientating our investment portfolio to minimize taxes to the greatest degree possible. And basically what I've seen is most investors, most folks watching this video have the bulk of their assets, the bulk of their net worth in two buckets from a tax perspective. The taxable bucket, which is tax me now, that includes brokerage accounts. It can include real estate, cryptocurrency accounts, collectibles, anything too that gets a 1099. That would be the taxable bucket, or the tax deferred bucket, which is traditional IRA, SEP IRA, simple IRA, traditional 401k. This is where the bulk of Americans have the bulk of their money invested and allocated. And these are the two buckets that are most at risk for coming wave of higher tax rates, dramatically higher tax rates. And so that tax-free bucket, number 3, as you can see here, is where most of us should be allocating our money and getting that money from the taxable and tax-deferred bucket into the tax-free zone, which will shield us from the coming wave of higher tax rates. And you could do that a couple of ways. You could do that through outright contributions to Roth IRAs, or Roth 401k plans, if your company offers that. These are the some of the 2024 numbers. Now, you do get phased out if your income is too high. You can see here for singles and marrieds, if it's above certain thresholds, you're phased out of Roth IRA. There's other ways to get around this, perhaps Roth 401k contributions or Roth conversions. If you've got too much money in that tax-deferred bucket, that would be another way to get money into the tax-free zone. So these are just things I want to keep you abreast on and aware of. This is a developing theme that is going to be, one that you want to plan for and not just think about, but actually to start taking some concrete steps. Not a single year should go by when you're not shifting money into the tax-free zone. Check out the description section below. I've got a free ebook that we just published called 60 Smart Ways to Retire Better that covers some of this, along with distribution pitfalls, estate planning, navigating markets, staying disciplined. Social Security, that's a big one. When should you start taking it? And then, of course, taxes. And one last reminder before we end today's episode, ETF Guide TV is now everywhere. Check us out on Amazon Fire TV, also Apple TV. We just added that. And then, of course, Roku. So be sure to check us out. And we've got brand new episodes of First Look ETF coming up for July, as well as ETF battles, ARK-K versus VGT. I'm looking forward to that. And hit the subscribe button. Don't miss any of our upcoming episodes. And hit the comment section below. Let me know how you're doing. I'm Ron DeLegge with ETF Guide. Great to see you again. And I'll catch you on the next episode.